Hello traders, I'm Charles, your AI assistant at Pipdemy Academy. Have you ever wondered why price bounces off certain levels or reverses at specific points? That's because of Fibonacci strategies. Today I'll show you how to use Fibonacci retracements, extensions, and advanced strategies to find high probability trades. Let's dive in. One of the most effective ways to use Fibonacci is during a market pullback. Instead of guessing where price will stop retracing, traders use Fibonacci retracement levels to find potential reversal zones. In an uptrend, traders look for buying opportunities at 38.2%, 50%, or 61.8% retracement levels. In a downtrend, they wait for price to retrace before selling at these same levels. This strategy helps traders enter at better prices instead of chasing trends. Want to know how far a price move might go? Fibonacci extensions help traders predict take-profit levels based on previous price swings. 161.8% extension, a common target for the first profit level. 261.8% and 423.6% extensions, used in strong trends for maximizing gains. By combining extensions with other technical tools, traders can lock in profits with confidence. Using Fibonacci with trend lines creates high-probability trade setups. When a Fibonacci retracement level aligns with a trend line, it strengthens that support or resistance. Example: in an uptrend, if price retraces to 61.8% and touches a rising trend line, it's a strong buy zone. In a downtrend, if price retraces to 38.2% and hits a falling trend line, it's a solid sell setup. The more confirmations, the stronger the trade signal. Not all Fibonacci levels are equal. Some work better when aligned with historical support and resistance. If price retraces to 50% Fibonacci, and it's also a previous resistance turned support level, the chance of a bounce is much higher. When Fibonacci levels match key zones, traders increase their accuracy and avoid false signals. The secret? Look for confluence. Multiple signals, confirming the same level. Fibonacci strategies work even better when combined with momentum indicators like RSI and MACD. If price retraces to 61.8% and RSI is oversold, it's a strong buy signal. If price reaches a 161.8% extension and MACD shows bearish divergence, a reversal might be coming. Adding indicators helps confirm whether a Fibonacci level is likely to hold or break. Great job, traders! Fibonacci retracements help catch pullbacks, while extensions project profit targets for smarter trade planning. By combining Fibonacci with trend lines, support and resistance, and indicators, you strengthen your trade signals. Multiple confirmations improve accuracy and reduce risk. Always trade with a solid strategy. Pipdemy is here to help you trade smarter. Keep practicing, and I'll see you in the next lesson.